decision support engine is a component system of different technical indicators that I have put together over the past 30 years. We're going to run through a few of them, not all of them, but a few of them right here so you get a feeling for how easy and simple and clean it can be to let the market tell us where it's about to go or about to stop going. So I'm going to change again to the Dow Jones because a lot of people like to think in Dow points. And here we are earlier this week. It is currently I'm doing this on July 21st, 2015. And you can see over the past 2 months, since middle of May, the Dow has made this ultimate life of contract high here around 18,350, and then it's made a couple of lower highs. So what do those lower highs mean? I don't know. Let's go ask the decision support engine. First thing we look at is right down here. I'm in the upper right-hand corner of your screen, the daily chart. The daily stochastic has just crossed down, red crossing down through green. That's a stochastic sell signal. Does that mean I go short the market right here, right now? Well, it does mean I don't buy the market. So when we get any type of component within the DSE to issue a sell signal, we no longer are okay with buying actions. The question is are we okay with selling actions? Well, let's try and get some situational awareness. Look one chart to the left. This is a weekly bar chart, and here we can see the weekly stochastic is just crossing up. So we've got a mixed message between the daily chart on the right and the weekly chart in the middle. Now let's look all the way to the upper left-hand corner. That's the monthly chart, and let's zoom in a little bit on that. And the stochastic, as we can see, has crossed down. So we have the monthly down, the daily down, and the weekly up. Well, we know we're not going to do any buying now because the daily stochastic is down. That is one of our key action symbols, action signals. Now, what we're going to do is we're going to now look below the surface of the market and see what else is happening. We're going to look over here on the second row, all the way to the left. These are the intra-day bars at various durations. Far left is the 478-minute bar. Next to the right is the 122-minute bar. Next to that, to the right, is the candlestick, which is 31-minute candle. Then the 8-minute bar. And then finally, far right-hand corner of the second row down, the middle row, is the 1-minute bar. So we're not getting a whole lot of information other than the far left corner, the 478-minute bar. And that's very similar to the number of minutes in a trading day. So we're going to get a similar picture there. So we're negative on the stochastic level. Now what else can we know? Well, I'm going to blow the chart up full screen. I'm going to move it over so we can zoom it in. And we can see that right here in the middle where price is right now, we're halfway between the upper Bollinger Band, this purple dashed line, and the lower Bollinger Band. So we're not getting any DSE support from the Bollinger Band component of the decision engine, the algorithm that we use. What about the dark blue line here? That's the 200-day moving average. Well, price is not anywhere near the 200-day moving average, so we're not getting any help from that. What about the 50-day moving average? Oh, okay, so today, July 21st, 2015, we had a big down day. The Dow was down 180 points, and it sliced right through the 50-day moving average. That's another short-term negative. So that, along with the stochastic cross down at the bottom, gives us two feathers in the bearish cap. Do we want to take a short position? We're not sure yet, but we certainly do not want to take buying actions. We don't want to buy more on this dip. That's not saying the price can't go higher. It's just saying the objective decision support engine is telling us that the conditions are not ideal for adding money to the long side of the market, to getting your money back in the market, or to adding money to the market, or to using leverage or margin in the market. That's not a good time to do that. When's a good time to do that? Good time to do that is when the stochastics at the bottom of the screen are below the 10% threshold line. That's this maroon dotted or dashed line at the bottom. Here, above the 90% threshold, that's where we don't want to buy and we want to think about selling. Below the 10%, that's where we don't want to sell and we want to think about buying. So this green bar I've drawn here, I'm going to extend it to the right. When the stochastics are in this green bar area, we want to be buying, not selling. When the stochastics are in this red bar zone at the top, we want to be selling and not buying. What else can we look at? Well, we've got help from the 50-day moving average. We've got help from the stochastics. What about these standard deviation lines? Those are these gold and orange and red bands above and below this 200-day moving average. Well, price is in the middle of all that potential technical help. So they're not giving us any help at all, which means at the few indicators that we're going to talk about today, the only things that are giving us help are the 50-day moving average breakdown and the stochastic crossdown. So we talked about 1, 2, 3, 4, 5 different indicators. 3 are neutral, 2 are negative. So in our thought process, what we want to be doing at this moment is ceasing buying action and preparing to take selling action. What might that mean? That might mean at some point below current prices, if we're still long and exposed to the buy side, where we would exit. If we're not going to exit now, where would we exit? Well, certainly we would exit on a close below this 200-day moving average. And we'd also exit on a close below this lower Bollinger Band. And until this stochastic leaves this red zone and enters the green zone, we're going to be looking for reasons to sell, not reasons to buy. Let's flip through another market. This is going to be the ETF known as IWN. This is the ETF that tracks the Russell 2000. Zoom in on it. So we just looked at the Dow, which is an index, which is hard for people to necessarily trade unless they use a Dow ETF. But a lot of people in our subscription base, our members, they like to use ETFs on the Russell 2000. So here's what that looks like. We're going to look at the same type of decision support indicators. First, we're going to drop down and look at the stochastic. Stochastic just crossed down, but it did so from a lower high. Just like price rolled down from a lower high. So unlike the NASDAQ, which is right now making higher price highs, the Russell is making lower highs, not confirming the NASDAQ's new price high. That's a warning signal. It's a divergence between different sectors of the market. What is consistent here is that this weak bounce in price is also showing a weak momentum condition as well. So money is coming out of the Russell and possibly going into the NASDAQ. The safer, bigger cap technology stocks are getting the money that is coming out of the smaller cap Russell 2000 stocks. What about this 200-day moving average? Well, it's almost about to act as support. Another day of selling and it will begin to support price, as will this lower Bollinger Band. So tomorrow or the next day, these two support lines may come into play and begin to support price. On the other hand, the stochastic has so far to go to get back to this below 10% level that prices could kind of hang out for a day or two of sideways and then begin to roll over in a big way, in which case they would free fall all the way down to this lower 2 standard deviation band. Several weeks ago, we drew this up arrow and down arrow and up arrow and down arrow to show our hallucination of what price behavior might be in the coming weeks. And these price bars here are actually following at least the up arrow portion, and they're beginning to roll over in this down arrow. And the reason we pointed this down arrow to this area surrounding 93, 94 is that that's where the 200-day move, that's where the lower two standard deviation band will be kind of beginning to support price as well if the 200-day moving average and the lower Bollinger Band fail to support. As we see earlier this week, the 50-day, this upper blue band here, the 50-day was broken and it was never even reapproached from the downside. So these signals tend to come in serial fashion. One signal breaks, then the next one breaks, and the next one breaks, and the next one breaks. What we're trying to do with the parts of our decision support engine that we're not going to be able to show today is anticipate after one breaks, what are the odds of further breakdown in the indicators, in which case we can position our shorts and up here on the bounce and get out of any longs that we were hoping to rise into that bounce as well. It's not just stocks that this works for. Let's take a look at the bond market. This is the futures contract for the 30-year bonds. Same process. Step one, look at the stochastics. They're kind of neutral, not overbought, not oversold. What happened in step two? Price came down into this lower Bollinger Band, broke down through the 50 and the 200-day moving averages. The 50's here, the 200's here. The lower Bollinger Band came into play, as did the stochastics turning back up. Now price has risen, and we're now going to evaluate whether or not the bonds have further to rise or whether or not they don't. So here's the upper Bollinger Band. It's not acting as resistance yet. There's no real resistance till this swing high from late May over here. That's the 156 level. So just to make my eye catch that, I'll draw a line across there. And just to be aware, make myself aware of kind of what the current situation looks like. The worst case scenario is maybe the bonds will figure out a way to get up towards 156 before they head south and start to knock on the door of this low over here at the left from February, which was the 144 level. What else can we look at? Well, the lower two standard deviation band is below the horizon here, so that's not going to offer any help. So really we're looking at this area of the chart, and we're going to wait for either the stochastics to get back up above the 90 threshold and price to get back up into this resistance and the upper Bollinger Band. We're going to get short there. If we are long here, we're going to certainly get out of our longs and get short on a breakdown below this level, which is the series of lows from the past 2 months, as well as the lower Bollinger Band. Let's look at something like crude. Different commodity, different market, same process. The decision support engine, the way we run the DSE, again, we're not making any decisions on bonds and interest rates and the Fed and the FOMC and who's running for president and what's happening in Greece. Those are all stories that people use to justify taking emotional action when they could use a system like our decision support engine, our DSE, which disregards all the news and stories and just looks at what the market is doing and what the crowd of people that play in the market are doing. So here's crude. Crude got oversold down here in the 50-51 area in the last couple of weeks. And stochastics put in a higher bottom, even though they put in a lower price. That's a bullish divergence. That's telling us that this big selling pressure, this flush of selling, needs a break. And crude probably has a bounce up into this green line that I drew a couple days ago, maybe 54, 55, 56. Once it gets up into that area, these stochastics will be back up above the 90 threshold. It'll roll over, and the DSE will give us a sell signal, as the 200-day and the 50-day moving averages come in as resistance. We'll get short, and crude should take another leg down. Let's look at gold. That's not gold. Here's gold. Let's look at gold. Gold is getting absolutely pounded in the past couple days, past couple weeks, past couple months. And what can we say? Well, there's a lot of information that's being given to us right now. I'm going to zoom in on it so we can see it. Gold had a spike in the last couple days through the 2 standard deviation band, the lower 2 band, through the lower 3 band, almost to the lower 4 band. Now we know from statistics that this 2 standard deviation band controls 95% of normal trading. The 3 band controls 99.7% of normality, and the 4 band controls 99.9% of normality. So when prices get down in between this orange and red line, that's a time when making selling actions is very, very risky. On the other hand, making buying actions at oversold extremes like these standard deviation bands illustrate, as well as when the stochastics are at or below the oversold 10% threshold, those are high confidence, long-sided trades. And that's when the DSE is now and will continue to be signaling buying actions for the next several days. And over the next several weeks to months, we'll be projecting probably some type of slight dip back down to the 1,050 level, and then a sharp reversal back up into the 1,200 initial resistance level off this swing high from middle of May, and eventually probably up into the 1,300 plus level in gold. Well, what about things like currency? How about the euro? Let's look at the euro. Same process. Everything is the same. This is a decision support engine. We don't take action without the decision support engine indicating the probability of an outcome we want. So the euro has been falling for several weeks. Should we be getting short the euro now? Let's ask the DSE. Stochastics are crossing up. Well, that's a buy action signal, so we don't want to be selling. Lower Bollinger Band here, the purple dotted line, it's acting as support. That's a buy action signal, not a sell action. The lows from this May low are being double tested right now. Buyers are coming in. That's a buy action, not a sell action. The 50-day moving average is significantly above the price. In other words, it's not going to likely come into effect today, so we don't have to worry about that. The Bollinger Band, the upper Bollinger Band is up here. The 200-day moving average is up here. So in the next several days, odds are the euro is going to move up into this range somewhere between 1.11 and 1.15. And at that time, depending upon where the stochastic is and some other indicators, we may decide to exit our longs that we put on in this neighborhood, 1.08 today, 1.09, and exit those longs and perhaps get short. So in roughly 15 minutes, we've gone through several stock indexes, the bonds, crude, gold, and euro, all in the same exact way, objectively, not bringing opinion or ego or news or things we would like to have happen or things we think we know are going to happen, but just asking the market, what are you telling us about what you're about to do, and how can I get involved in that? So that's a wrap-up of the basic components of the decision support engine, and we hope that you will put them to use. Thank you very much.